inflation above 5% for 3 consecutive months. Well, if you round up to 4.99 in May, I'm talking about 2021, but there was a recent moment in American history when it was absolutely above 5% for 3 consecutive months, even 4 months almost. And that was 2008. And that's not a moment in time when you consider that there's this surplus of money flooding the economy, 2008. We're going to talk about what happened in 2008, if there are any analogies to present day, and where we think inflation may be heading with Jeff Snider, the head of global research for Alhambra Partners. Jeff, how are you doing today?
I'm great, Emil. Always happy to talk about inflation that isn't inflation.
Mr. Rudy Havenstein, the president of the Reichsbank, from in the
1920s, not the 2020s.
Yes, in the 1920s, a huge Twitter personality, even though he died many years ago, says he always cringes when he hears you say that inflation isn't taking place. We're going to expand on that. We don't want Mr. Rudy to be upset with us. We're going to talk about what you mean, Jeff, and we're going to be using an essay that was posted today, August 13th. This recording is on August 13th. Jeff, on Twitter, people have asked me to say what date the recording's taking place. August 13th, 2021. The essays at Real Clear Markets, There is So Much, Too Much, Just Enough the Same, by Jeffrey P. Snider. And we start out in 2008 when we did have those 3 consecutive months. It was the summer of 2008. And people were worried about inflation. And Jeff, you won't believe it. You won't believe it. Guess what I've got here? The Wall Street Journal.
Is that
you
a
may
contemporary?
think, whatever. Monday, August 4th, 2008, Jeff. What are the chances? Why would I have this? I don't know. The week ahead, the Federal Reserve. 2 officials, including one who currently votes on the rate-setting FOMC, indicated ahead of the June meeting a desire to raise rates immediately. Several others since then have signaled an interest in tightening policy before long to address higher inflation and the risk of a price spiral. This is 2008, August.
Summer, yeah, it blows your mind, right?
I'll give them a little bit of credit because it does say here that most officials, while still concerned about inflation risks, are more worried about restoring stability to the financial system to prevent more threats to economic growth. The summer of 2008, Jeff, inflation, Europe, the FOMC, what was happening?
Yeah, remember, we already talked about Europe. The European Central Bank had actually increased. They did go ahead with their benchmark increase in early July that summer. So, yeah, there was some concern, but if you read the transcripts, as I have, unfortunately, sadly, pitifully, I've read them all, and I can tell you these people were actually they were cautiously optimistic, but more optimistic than cautious because at that time, remember, oil was $140 some odd a barrel, and it would seem like commodity prices at the very least were saying, as now people can relate, that there might be something inflationary to this. And if we fix this little financial problem that seems to be going on in subprime mortgages, if we get that right, that really could unleash, a tidal wave of inflationary excessiveness and pressures. And so many central banks started to believe after Bear Stearns, they got that right. That little subprime mortgage saying, okay, it knocked Bear Stearns out of the box, but that was basically the extent of it. And they began in the summer of 2008 to look forward to maybe completely avoiding a recession entirely, even though it had already begun. But they thought that it might have completely avoided the recession and that the downside risks to the quote unquote financial system were being mitigated by successful monetary policies and all sorts of sentimental smoke and mirrors. And then turning their attention toward inflation, taking their eye way off the ball and looking at everything in that respect.
With our interview with Daniel Want of Prerequisite Capital a few months ago, he mentioned that there's a hierarchy in these markets. Commodity markets, very important signals. But bond markets, more priority, better analysis, better sense of what's happening, and that commodity markets have and can get ahead of themselves. Bond markets, sovereign bonds, US Treasury Bills. Jeff, I'm going to pull up a graph from 2008 that disagreed with commodity markets and the FOMC and the European Central Bank. Tell us what we were seeing here.
Treasury bills, one of our favorite instruments to obsess about. It's, the bill market, the front end of the yield curve, because Treasury bills are, of course, they're always on the run. So they're the best of the best. Treasury is already the best repo collateral, best any collateral out there. And Treasury bills, the best of the best of the best. And you can see, when you get to the summer of 2008, what you find is that as all of this inflation stuff was going on, you can't really see it on the monthly chart, but especially in July 2008, what you'll find is that the 4-week T-bill was trading significantly less than the federal funds rate and the federal funds target. And that's important because the 4-week Treasury bill is sort of a monetary equivalent. It's the closest monetary equivalent to something like federal funds or repo or anything like that. So you would expect, and throughout history up until 2007, the 4-week Treasury bill rate would by and large follow along federal funds and the federal funds target. LIBOR and all these other things demonstrate a very clear relationship, correlation, and hierarchy that made it seem like the Fed was in charge of all these money markets when really it wasn't. And as those things started to break down post-August of 2007, we get to 2008. While the CPIs were through the roof, inflation looked like it was 5% and better in those places. In July 2008, the 4-week Treasury bill rate was substantially below the target. At one point, I think it was July 11th, 2008, the 4-week T-bill yield was about 1.38%. And at the time, the Fed's target was 2. So it was 62 basis points below target, which should have been setting off all sorts of alarm bells, because you're thinking, why on earth in July 2008 would Treasury bill yields be 62 basis points below the federal funds target? It's not that the Fed controls the rate, but that's where, if everything was becoming normal, we would expect the T-bill rate to be more like the federal funds target, at least much closer to it than where it had been. And again, we're talking about Treasury bills, we're talking about collateral, and if the price is that high to bring the yield so far down below, that can only mean excessive demand for bills, which relates to potential collateral shortage. And maybe not a huge shortage in July 2008, but participants in these vast money markets that span the entire world looking ahead and saying, I'm not so optimistic here. I may want to hoard bills now in case something really does start to go wrong. And that's really what the contrast in 2008 was. Here you have the bill market saying one thing, and you have other bills like Bill Dudley at the FOMC saying quite the contrary. And yes, they kept saying we're cautiously optimistic, but they also were very optimistic. They were becoming more optimistic and more concerned about inflation, not just in Europe, but also in the United States, as you just pointed out in the Wall Street Journal article.
Yeah, so was the 2% target in place all year long, Jeff, in 2008?
So that was the post-Bear Stearns target. So the 2%, that's where they brought it down from late 2007 into March 2008, and then getting all the Bear Stearns stuff, they brought the federal funds target down to 2%. Where they left it, it would stay at 2% all the way through September. So 2% they thought was enough of a federal funds, enough of a drop in interest rates that it would cushion the economy, cushion the financial system, just by lowering the federal funds target, without paying attention to the fact that, as I just said, Treasury bill rates were substantially below, and at the same time, 3-month LIBOR and other LIBOR rates were substantially higher. So you had unsecured markets saying shortage of funds, shortage of dollars outside the United States, offshore, and then Treasury bills, prices sky high, shortage of collateral everywhere. I mean, these are bright red flashing warnings through the summer of 2008 that should have gotten everyone's attention, except for the fact that these central bankers aren't really central bankers, they're a bunch of economists.
But Jeff, here on July 24th, 2008, you quote one Mr. Bill Dudley, former chief economist for Goldman Sachs, PhD in economics from Berkeley, a wonderful institution. Quote, and we're talking about collateral now. I also want to point out that for the banks that don't have enough collateral today, so they know about the bills, Jeff, they know about them, that doesn't mean that they don't have collateral available. It is just that the collateral hasn't been pledged at the window, Jeff Snider. So the bottom line is that we don't think the over-collateralization requirement is very constraining. To use economic terms, the shadow price of collateral is pretty close to zero as far as we can tell.
Yeah, I mean,
it's a little confused. It's a little economic talk, Jeff. Can you translate it to English?
We have to unpack quite a lot here, but just, spoiler alert, it's another one of those Bill Dudley statements that will very shortly blow up in his face. And it will blow up in his face in an absolute spectacular fashion where we, the public, have to pay for their idiocy, their incompetence, and their inability to understand things as they were going on. So July 24th, 2008, the Fed held a conference call, one of those emergency conference calls to discuss altering their monetary programs because they were hearing noises from the banking system. And they were thinking, a bunch of crybabies. We fixed Bear Stearns for you. What the hell do you want? So they said there's two proposals on the table that required not just the FOMC, but also the Federal Reserve Board to vote. They got all these people together and they talked about it. One was extending the maturities on TAF auctions, and the other was this option arrangement on the TSLF, which was the Term Securities Lending Facility, which is essentially securities lending and transformations that private security and money dealers do themselves. And what was really concerning the banking system that were knocking on the Fed's door was the banking system said, hey, you may not have noticed, but we noticed the fact that at quarter ends, there does seem to be these real severe bottlenecks. Oh, by the way, you might have noticed that when did this Bear Stearns fiasco happen? Well, it was getting into that quarter end period in March. And so, as Bill Dudley even said, the question we get asked most is what are we doing about helping banks get through quarter end periods? And so here they are talking about, well, let's extend TAF auctions so that banks know they have a liquidity outlet over any quarter or year end period. And let's also do this TSLF option, which gives banks the ability to swap lower tier collateral for treasuries and some. We don't need to get into the details of it, but essentially a basic securities transformation transaction. So the one thing you said, Emil, is absolutely right. They know about this stuff, but that doesn't mean they understand the full implications of it, nor the consequences when these things go wrong, or really how they fit into the overall system. They're basically responding to feedback from the banking system, which was telling them, as we talked about the Lehman emails, the banks were all saying, look, you guys can be optimistic and cautiously optimistic and think things are going fine, but down here inside the monetary system, which you guys pay no attention to, we're still really concerned. And we're really concerned about a couple things. Number one, collateral, and number two, quarter ends. And wouldn't that just be the case September of 2008, 2 weeks before the quarter end? What happens? You had the violent intersection of a collateral shortage at one of these calendar bottlenecks, which rendered all of these stupid monetary programs, the TSLF, TAFs, any of these initialized programs were completely, utterly worthless and helpless against the looming crisis. And the point we're trying to make here, Bill Dudley says, well, I guess this collateral quarter end stuff might be a big deal, so let's conjure some kind of program to make these banks happy because we think the shadow price of collateral must be zero. And that was absolutely patently false. And you could have just looked on Bloomberg on that day and known that because the price of Treasury bills were telling you the shadow price of excessive collateral must have been through the roof because that's the reason why banks were hoarding Treasury bills in advance of trouble they thought was much higher probability than anybody at the Fed did. So it's one of those perfect episodes where the incompetent Keystone Cops Federal Reserve people are just, we're more concerned about the CPI than collateral and seasonal bottlenecks. And then what happens in just a couple months later? It's the collateral and seasonal bottlenecks that conspire to essentially destroy the economic system, or or at least knock it off of its axis, so that it was essentially a permanent shock, one from which we have yet to recover. And our other point here is that even though this was such a big deal, and even though they got everything wrong, even today, hardly anybody knows these things. Everybody has been dazzled by QE when in fact QE doesn't really have much to do with anything here.
Your listing of all that alphabet soup reminded me of an early, very early, original David Parkins illustration in 2000, March 2020, when we did the same thing. All these alphabet soup programs, but of course they're just looking the wrong way. So wonderful, you've got a cape, but you're looking the wrong way. Okay, our focus is on inflation. We talked about 2008, the summer.
Well, the epilogue to the 2008 story in terms of inflation is obviously those 5% CPIs disappeared really quick. And why did they disappear? Where did those 5% CPIs go? They were subsumed by the deflationary money system, which was already exhibiting those signs and those potential while those 5% CPIs were happening. The bill market, just the Treasury bill market told you, sorry, Bill Dudley, that there was collateral concerns, grave collateral concerns being expressed, which were representing an enormously high potential for deflation, not inflation. And that's, of course, exactly what happened. Yes, 2008 was an extreme example of those deflationary consequences, but they come in different variations and gradations. So it doesn't always have to be a 2008 type, 2008 level of event, of deflationary event that will undercut the inflation, the apparent inflation at any given time.
Bill Dudley and inflation versus Treasury Bills, 2008. Now we've got a rematch, Jeff. It's Treasury Bills again, but this time the challenger is Bill Simon, and he's not an economist, Jeff. He's a person who's got his fingers in the real economy, okay? So this time it's going to be a serious match, and I think the US Treasury bill market have met their match. US Division Chief of Wal-Mart, the CEO of Wal-Mart for the United States, Bill Simon, quote, we're seeing cost increases starting to come through at a pretty rapid rate. Inflation going to be serious. Now pull the rug out from under us, Jeff.
Yeah, I mean, you would think that was something Bill Simon said, or any CEO of Walmart said yesterday, right? I mean, this surely was printed recently.
Yes.
Except no, this quote was taken from the head of Walmart. As you pointed out, this guy's not an economist. He's the head of Walmart. So obviously he knows something about the retail business. And since Walmart has made its business on being sensitive to prices, surely this guy cannot possibly be wrong about inflation, right? I mean, who would we turn to other than Bill, the guy, the head of Walmart in the United States? If we're worried about retail and consumer price and all these, we would obviously want to talk to Bill Simon. And the answer is no, you wouldn't, because that quote wasn't today or yesterday or even recent. It was March of 2011. He said consumer prices are about to be very, very big, and that we should be really concerned about inflation. Except over the decade following his quote, hardly anybody was concerned about inflation except for the fact that it was continuously missing. So maybe Bill Simon's not the guy we want to talk to either.
But you know who we could have talked to at that time? US Treasury Bill. And I've got another graph this time, and again, it's monthly. Forgive me, Jeff. I've got 2010, 2011, but we can see 2000.
So now you're going to force me to describe the daily movements.
Basically.
Yeah, I think you did this on purpose.
Forgive me.
No, so yeah, you're right. Again, here we have another episode. And if you could think back to 2011, Bill Simon's view was hardly controversial at all. In fact, it was probably the mainstream view. Everybody was thinking, what the hell is going on? Prices seem to be going through there. I remember, you'd go to a fast food restaurant and they'd only give you one napkin because everybody was so worried about the price of paper, for example, because inflation was so out of control. This price spike and obviously if the CPI is up around 4% as it was in 2011, it's going to continue because these things are never temporary or transitory. That's what we keep hearing. If prices go up for any short period of time, it's extrapolated into 1970 style. But yeah, as you pointed out, Emil, what we're really talking about here, there was trouble in bills, Treasury bills. And it started before 2011, where you had in November and December, especially December 2010, you had this curious drop in bill yields When? Shortly before the quarter end, shortly before the year end in December of 2010, a drop in bill yields that was out of line from where bill prices had been previously. But it wasn't just that, though. That was sort of the prelude, because as you get into right around the time that Bill Simon was talking about inflation, it was sort of as if someone had yanked the rug out from under the bill yields, which meant prices through the roof. In fact, the bill yields would get down to around zero, 1 basis point, a couple basis points around May and June of 2011, which was, again, alarm bells. What is going on here? Because this is not what we should be seeing from a healthy monetary environment that would be leading to an inflation. And again, when we talk about inflation, we're not talking about temporary changes in a few prices or another. We're talking about broad-based rise in consumer prices that is sustained over a prolonged period of time. And the reason for that broad base, as well as being sustained, is because of monetary excesses. Inflation, real inflation, is always and everywhere a monetary phenomenon. And if you don't have the monetary environment for that to happen, you're not going to get inflation. So just looking at bills in early 2011, as these things were unfolded, CPIs were still high, around 4%. They weren't like 2008, but they were still relatively high. As they were still relatively high, the bill market was saying it's not going to last. There's deflation. There's too much deflationary potential being exhibited right now, today, let alone in the near intermediate future or long run future.
You summarize what was happening in 2008 and 2011, despite the inflationary concerns, very well in these two sentences, so I'm going to read them. There were two major factors which contributed much to this unhappy yet predictable set of deflationary outgrowths. The first, what had been building since early 2010, in the form of dealer risk aversion feeding into reduced securities lending activities, thereby shrinking the systemic collateral multiplier. Earlier we talked about 2008. We quoted Mr. Dudley. Now we're going to quote another member of the FOMC here. Was he yes, he was part of there. He was speaking.
He was Bill Dudley's successor, actually.
Mr. Sack. Now we're talking about June 2011. Here comes Mr. Sack. Some market observers are concerned that the looming debt ceiling is going to impose substantial squeeze in the supply of Treasury bills. So again, they know about this bill stuff, as the Treasury attempts to maintain its coupon issuance while its ability to borrow is limited. They believe that Treasury bill yields and general collateral repo rates could be driven negative in response, potentially inducing a number of unusual market issues. What is this telling us about inflation and bills?
Kind of sounds familiar, doesn't it? I mean, again, this is like Bill Simon's quote. This quote from Brian Sachs sounds like it could have been pulled out of today or yesterday or this week.
Yes.
It's eerily familiar because we keep repeating these problems. So, getting back to what you just said, they know about bills. So what? Apparently they know there's something going on in bills, but yet here we are repeating the same things over and over again. And the point I was making about 2011 is that you had this pre-existing collateral problem in dealer risk aversion, creating a lower multiplier to begin with. And then along comes the Treasury. And, we can't fault Treasury for this, because Treasury has to do what its job is, which is to manage U.S. government's debt. And if they have a debt ceiling that they can't meet, then they have to do these things. They have to refund bills, for example. But you have in the monetary system, in terms of effective monetary conditions, that is a restriction, a negative factor on money. So those two things combined at the worst possible time. You have dealer risk aversion, and then a shortage of Treasury bills leading to the summer of 2011, which was very nearly, people don't appreciate how nearly, a repeat of 2008. And it was devastating. We may not have noticed much here in the United States, but around the rest of the world they sure do, especially in Europe, because there was a re-recession in Europe. But in many ways, 2011, as Emil, you and I have talked about this a lot, 2011 was sort of the final nail in the coffin. And what we're talking about is in some ways, the primary final nail in the coffin of the recovery, because it was another repeat episode of collateral shortage where the Fed knows about bills but doesn't do a damn thing to offset it. and it leaves the system so short of collateral that as soon as it ran into just the tiniest little spark, it became so much more disruptive than maybe it ever should have been. And it was just and under those kinds of conditions, those kinds of situations, with dealers and bank and the whole monetary system aware that this is how it is, you can really start to understand why from that point forward we've been in a consistent deflationary environment, because monetarily speaking, which is what inflation really is, this has haunted the system ever since. 2 episodes in close succession of largely the same thing, with policymakers talking out their mouth one way and the system going in another completely different way, naked to all of these problems. Yeah, deflation seems to be the most rational outcome of all of this, not inflation. And again, notice what we haven't talked about: bank reserves, QE, money printing. In fact, the quote I always love from August of 2011 is also from Brian Sack, where he says, I should note that all of this dramatic illiquidity we're seeing in repo markets and global dollar markets is happening even though there's 1.6 trillion in bank reserves in the system. So yes, there's another thing. The Fed knows that bank reserves do not necessarily lead to functional liquidity, and I argue all the time that it doesn't contribute much at all to functional liquidity. And that's really the problem here. Inflation is a monetary phenomenon, but our view of inflation is colored by this textbook approach, which says, don't fight the Fed, look at bank reserves, look at QE, look at the Fed's balance sheet, when in reality, the only thing that matters is all the stuff that's outside the Fed, off its balance sheet, in these shadow money places like collateral. Collateral is one of the most basic primary elements of shadow money, and it's not really that shadow, right? I mean, as Bill Dudley said in 2008, the shadow price of collateral, well, it's right there in the T-bill yields. Mm-hmm. It's actually not that shadow at all. If you see the T-bill yields behaving oddly, there's a direct implication for what must be happening in these quote unquote shadow spaces.
Let us fast forward then to 2021, present day. You've said it a couple of times that there are so many analogies. We've had the 3 consecutive months of inflation above 5%, or nearly so. What was it, 4.99 in May?
Yeah. With
CPI headline numbers. We also have the Treasury, US Treasury, pulling bills out of circulation. At least earlier this year there was talk of that, right? And so let us turn not to another bill, but the bill that was right this whole time, US Treasury Bills. And again, they're warning us. But in your paper, Jeff, you say, hey, it's not warning that it's going to be exactly the same, 2008, 2011, but it's warning what?
That something's not right. It's really what we're talking about here with the bills is deflationary potential. What the bill prices are saying is that collateral demand, put it in Dudley's terms, the shadow price of collateral must be exceedingly high because money market participants are hoarding Treasury bills. Now, yeah, I know people in 2021 have said, oh, that's just too much money. That's bank reserves. The Fed is flooding. The TGA is being drawn down. All of that kind of crap. Money market funds are flush and they're looking for places to put it. Yeah, that's true. But as we've said, when you compare bill yields that are below the IRP, for example, that's the same kind of thing as bill yields being below the federal funds target in 2008. Not to the same degree, but it's an indication of collateral demand over and above what, quote unquote, should be happening in the bill market. And as you're showing here, the 4-week Treasury bill that's down, almost a full basis point below 5, that's a clear indication of a collateral scarcity problem, which is deflationary potential being traded in this most liquid marketplace, which means that the view from inside the system is that collateral is such an issue that the 4-week bill yield, not just the 4-week bill yield, but some of the other, the 8-week, the 3-month, and at times the 6-month bill too, they trade at such low yields below the RRP, which is an expression of this collateral scarcity. And therefore, that means in just this one case, and there are others, this is just one part of the overall whole, the system is exhibiting deflationary potential that is quite serious. And from that, we can interpret a forward condition that is not inflationary. Like 2008, like 2011, these CPI spikes will be transitory because these monetary problems are likely to be too excessive to overcome.
Earlier, you mentioned that 2011 was the final nail in the coffin for, as I like to think of it, advanced economy money centers creating our monetary order, the surplus of credit, cash, and collateral. There was some thought that perhaps emerging markets had detached, delinked. But then we had that next crisis, 2014 through 16, which that proved that was the final nail in their coffin, that they're not going to escape either. Which brings us to an epilogue of our story. 2014, July 24th, USA Today. Wal-Mart US CEO Bill Simon steps down. Let me read a few sentences here. As it grapples with sluggish store sales, Walmart said Thursday that its U.S. CEO is stepping down and is being replaced by the head of the company's Asia operations. The move comes just weeks after Simon made fairly dire comments about consumers and the economy in a July 8th interview on CNBC. Referring to unemployment numbers, Simon said it was, quote, going to take a while for those numbers to balance out, and singled out low and middle income consumers as being, quote, still pretty challenged. Sales in the USA have been lackluster for Walmart, which reported its smallest growth in quarterly sales in nearly 5 years in May. The company, like most retailers, blamed severe winter weather in the Northeast. Jeff,
Yeah.
I mean,
I think Bill finally learned that, monetary restriction, deflationary pressures translates into the real economy, as John Maynard Keynes had said in the 1920s, almost a century ago. Deflationary potential, deflationary outcomes come out worst in the labor market. John Q. Public.
But he knew about it. He knew about that. He knew about the Walmart shoppers were struggling, and he said so on CNBC, and the head of Walmart didn't appreciate it, but he was right. You said 2011, 2012 was a
Emil,
near...
that's our challenge, right? Bill Simon found out about the Walmart shoppers, and Bill Dudley says something about TSLF, and there's quarter ends and there's all of these dots that are just floating out there that the economics textbook doesn't really tell you much about. All we're doing is we're connecting these things together and saying, yes, this Bill Dudley thing in 2008 is related. It's absolutely related to the Bill Simon getting canned in 2014 via all of this other stuff that you don't even know about or you don't hear about, because we're all supposed to think that money is easy and the Fed controls everything with the flip of a switch, or the increasing the number at the end of the letters Q and E. That's not what happens. That's not what takes place. And just in terms of inflation, it's even more important to understand what goes on in reality in the monetary system. Otherwise, you're going to be fooled by these CPIs into thinking they're more than they are, as the European Central Bank was in 2008. And by the way, again, in 2011, there were 2 rate hikes in 2011, not just one. So, yeah, maybe T-bills, T-bill yields is a very good place to start, because I said, yes, most of the stuff does take place in the shadows, but T-bill yields is probably the tip of the iceberg that is sticking up out of the water. And it's a good place to say, okay, are we really seeing what we're seeing? Are these CPIs really representing true monetary inflation, or is there something else going on here?
We're going to talk about that next in part 2. We're going to look at the actual CPI results. We're going to break them down and see if we can learn anything. Does it seem as if this is going to continue further, or can we already see in the CPI numbers that there's a change taking place, an inflection?